flagging that off with us. In fact, let's take this forward. We have the company's management, Amit Kalyani, joining in. He's, of course, a Deputy Managing Director at Bharat Forge. Amit, thank you very much for joining us on this call. So let's start by what made you lower the guidance and what is making you sound far more cautious, not just in Q4, but even the next year. What has changed?
So look, basically, our commentary is derived from what we hear with our customers. Our markets are our export markets are largely in Europe and US, and I think both the markets are seeing some amount of cyclical peaking, and Europe is under other pressure, right from cost increases due to both the geopolitical events in their vicinity and lots of fundamental changes in the overall European marketplace. So many sectors are seeing moderation in growth, even slowdowns. But we expect that we will continue growing as a company, except that this year we are growing 20%. I don't think that is always sustainable. We will continue to grow because we have many growth drivers of our business. Even if these main sectors do not fire as much, based on the market share gains and the new sectors such as industrial, aerospace and defense, we will grow and grow profitably. But there is cause for concern because sectorally, the agriculture sector, the construction and mining sector abroad, marine, even rail are sectors that are getting under pressure. So many end markets are slowing down, or at least seeing some slowdown for this present moment.
Amit, in November, when you had sort of spoken after the earnings for the second quarter, at that point also, from what I can see, you had said that commercial vehicle exports, the export market on the CV side, is likely to remain flattish for FY25. So you're not expecting growth or anything. You're now saying that is worsened. You'll be negative 4-5%.
No, so look, I think US will be positive because it's going to be driven by the infrastructure growth. Elections are going to happen around that time, so there will be some push for growth. Plus, there is the whole emission norm pre-buy that's going to happen. But I think Europe will be slightly down. And overall, I think it will be flattish. But because of the market share gains, I think we should be having a positive growth. But there are many other sectors where we don't see the same thing happening. Sectors that were largely driven by China or where China was a big growth driver are going to see pressure. And, that's something that will play out for all companies. I think we're just being prudent and calling it out upfront because we, believe in long-term rather than quarter-to-quarter kind of business. And I think that this is going to play out for everyone.
Hi, Mr. Kalyani. Good afternoon, and thanks so much for joining in. Nigel on this side. Could you quantify it? If you're going to see a modest or a bit of a slowdown in terms of growth for FY25, can you put a rough range to that number? That's on the revenue growth. And the positive, though, has been that margins have been improving steadily. What's the outlook out there? So I want to band on both these two parameters for FY25.
So on the growth side, I think, 10% growth is still, on the cards. If things work out better, could be, in that vicinity. I mean, it could be even higher than that if the markets perform better. Profitability on an EBITDA margin basis will be, in the ballpark, plus minus 100, 150 basis points. Depends on the product mix. So, I'm not concerned with profitability or the overall growth. I'm just saying that one needs to be conscious of the environment that we're operating in and, base your business model and base your plans on that and be realistic. It's not prudent for me to make unrealistic promises and then, sit and justify that. It's better to be, raise what are the concerns, what's happening in the market. Plus, in many of the geographies, the overall cost increases that the end consumers have had some amount of moratoriums or fixed for 1 year, 2 year, 3 years, which are going to get reset, and now that cost pressures will start hitting.
Amit, can we talk about your defense business? What were the order wins in Q3? What does your order book stand at? And how much of the export pain can be alleviated by the India defense business? What's the kind of growth you foresee in Q4 and FY25?
Currently, our order book is largely export, and it's about 2,000 crores. We have several new, let's say, programs which are going to be unveiled and which are going to be bid out. So that should be another addition to our overall defense business. Plus, we have many new programs where we are either in the final stage of development or in the partnering phase. So that will continue to drive our revenue going forward in the defense phase. As I had mentioned earlier, defense is now clearly on its way to becoming a strong and standalone business as a sense, which will continue to drive our growth both within India and exports. And we continue to see tremendous opportunities in export, and we will continue to take advantage of those.
Just to get that number, the defense order book is 2,000 crore. Is that
Yes.
correct? Okay. In Q2,
Absolutely.
it was about 3,000 crore.
Sorry?
So in Q2, if I remember correctly, was your defense order book 3,000 crore?
No. The defense order book hasn't reduced. We have started execution, and the orders that we have on hand, which are yet to be executed, are about 2,000 crores.
Okay, so Amit, just to round all of this up, as you're saying, defense and aerospace are still sort of shining areas, but some of your traditional end markets in Europe are seeing a slowdown. So if I talk about consolidated revenues, FY24, can the domestic market, where you're still growing at 30% plus you talk, of course, of defense being such a huge opportunity, to what extent can the domestic market make up for this pressure that you're seeing in overseas markets? And by the time you round up the year, what will be your domestic versus export mix?
So for this year, I think our export growth will be significantly higher than domestic. Also because, our export business in defense is very large. But clearly, with once the elections are behind us, I think the pedal will go on to the metal, and there will be a increase in growth rates through infrastructure and capex build-outs in India, which will drive some more additional growth in the domestic markets. So it's early to say, because I think we have this one big, inflection point yet to come in India, which is the elections. And once that is through, you will start seeing more clarity with what's happening.
All right, Mr. Kalyani, elections could play some kind of a role for FY25. So I want to talk about FY26 only on the defense vertical. Is it possible you do revenues of close to around 2,500 crores of revenues with margins in the mid-20s only in the defense vertical? Possibility?
Absolutely. It's eminently possible.
Okay, 2,500 crores with 25% margins.
I would say 2,000 plus with a 22, 23, 24, 25% margin. Let's say mid-20s margins.
Got it.
Absolutely.
I mean, just one last question. You'd said that you'd repay another 500 crores in the second half of this year. Could you give us the latest numbers? Debt?
So this year we have already repaid 500 crores.
Okay.
And between this year and next year, we'll repay 1,000 crores.
Okay.
And, we'll after that, we'll still have over 2,500 crores of cash on our balance sheet.
This is by the end of FY25.
End of FY24.
Okay, end of FY20 this year, this financial year. Okay.
Yeah.
Got it. We'll leave it there. I mean, great to speak with you. Thank you very much for joining us, and thank you for joining us first here on CNBC-TV18 with that perspective. The stock's down, 10, 11%. We're at about 1,170. We're on 1,170 on the stock price. That's a sharp cut which has come through, and no real recovery. I mean, it's not a really sort of, positive kind of market backdrop that we have as well. So one has to keep that in mind. 135.